If trading suddenly becomes more expensive, do people trade less or do they take bigger risks to make the same money? That is the question markets are grappling with right now. On 1st February, the Union Budget raised the securities transaction tax on futures and options. Now the reaction was immediate. Stocks slipped, volatility rose, and concerns surfaced about what this means for India's fast-growing derivatives market. In this market special, we break down how the STT hike could reshape F&O trading and who is likely to feel the impact the most. From 1st April, the cost of trading derivatives will rise. STT on futures increases from 0.02% to 0.05%. STT on options premium rises from 0.1% to 0.15%. STT on exercised options also moves up to 0.15%. Now these may look like small changes, but because STT is charged on every trade, the costs compound quickly. The stated objective is to curb what the government calls excessive speculation. SEBI data shows that nearly 9 out of 10 retail F&O traders lose money. Now in a single year, losses have crossed 1 lakh crore rupees. The government also argues that derivatives volumes are disproportionately large relative to the real economy. Even though volumes have fallen sharply in recent months, they remain significant. Data from the World Federation of Exchanges shows that F&O contracts traded on the NSE fell from 12.94 billion in October 2024 to 2.3 billion by February 2025. By December 2025, volumes had recovered only marginally to about 3.18 billion contracts, still far below earlier peaks. Now consider a futures contract worth 50 lakh rupees. Earlier, STT on that trade was 1000 rupees. Now it will be 2500 rupees. That is a 150% jump even before brokerages and other charges. For active traders, this directly reduces profitability. For options traders, especially scalpers, who rely on thin margins, even small increases in costs can erase returns. High-frequency traders are the most exposed. Their strategies depend on large volumes and narrow spreads. Retail traders come next. Higher costs mean lower effective leverage and thinner margins. Some may trade less, others may exit altogether. Institutional players are likely to adapt by cutting trade frequency. Then, there is also a wider impact. Brokerages, exchanges, and depositories earn from volumes. Lower trading activity means lower revenue, and that is why capital market-linked stocks reacted sharply after the budget announcement. This is not just about traders, it affects the entire market ecosystem. Views among analysts remain divided. Market analyst Shankar Sharma has played down the panic, arguing that India should not become a casino where speculative traders profit at the expense of long-term investors. His view is that if higher STT drives out purely volume-chasing speculation, that may not be a negative outcome. Others are more cautious. Most agree that higher costs could pressure derivatives volumes and near-term earnings for market-linked firms. But for long-term investors focused on fundamentals, the STT hike alone is unlikely to alter the broader market story. In short, the move may cool excesses in derivatives trading without undermining India's long-term capital market trajectory. Follow Business Standard for more such market insights.